In today's video, I want to talk about something it's something that almost nobody talks about. It's how you future-proof your structure so that when you're ready to settle down somewhere else, you don't have to suddenly dismantle your entire business or face massive taxes. If you don't know me, I'm Elliot, founder of the UK and UAE-based tax and accounting firm Make Accounting Simple. But on this channel, let's talk about tax. We break down complex tax topics for entrepreneurs and online business owners. Please note that nothing in this video should be taken as personal, tax, legal, or financial advice. This video is for educational purposes only. So let's start with the basics. If you've been following this channel, you'll know that most people who move offshore do it for two main reasons. One, to lower their taxes, and two, to gain more personal and financial freedom. And that's great. You move to Dubai or another low tax country, you set up your company there, you move your personal tax residency, and you enjoy all the benefits. Low corporation tax, 0% personal tax, better quality of life, unparalleled networking opportunities, etc., etc. But what most people don't think about is what happens later. Let's say 5 or 10 years down the line, you've built your business, you've made good money, and you want to settle down. Maybe start a family, buy a home, move somewhere in Europe, UK, Australia, or Canada. This is where things can get potentially complicated because the way you run your business now can completely determine how or whether you can move back home without paying massive taxes. So here's the thing, if you move back to a high tax country and you're personally living there full time, or even enough so it's your main home, you'll automatically become a tax resident there. That means that your worldwide income, your salary, your dividends, and even profits from your offshore company can suddenly be taxable in that country. Now you might be thinking, but my company's registered in Dubai and that's a low tax country, I'll still be fine, right? Not necessarily. Because while a company's tax residency defaults to where it's registered, in this case, a company incorporated in Dubai is a tax resident of Dubai, many high tax countries also apply what's called the place of management rule. That means that if you're physically living in, say, Spain or the UK or Australia, and you're the one making all the big business decisions from there, then the tax authority in that country can say, we don't care that your company is registered in Dubai. You're running it from here, and it's a Spanish or UK or Australian company for tax purposes. And just like that, your 0% Dubai company could suddenly be taxed at 20, 25, or even 45%, depending on where you've moved to. So how do you prevent that from happening? The answer is actually quite simple, but it just requires planning. You need to create separation between you and your company's day-to-day management. That means that if you want to live in a higher tax country later, your offshore company has to be able to run without you. In other words, you need to step back from day-to-day operations, stop being the CEO or general manager. Appoint someone based in a low tax country where your business is incorporated, like Dubai, who actually manages the business from there. That person, your general manager or CEO, needs to be genuinely based in that country. They need to make key operational decisions, manage staff, sign contracts, and represent the company locally. If you do that, your company keeps its place of management offshore. That means that when you're living in a high tax country later, your company's profits remain taxable in the low tax country, not where you live. Let's bring this to life a bit more in an example. Let's say you've been living in Dubai, you run an online business, and you plan to move to Spain in 5 years to settle down. You'll become a Spanish tax resident when you move there, which means you'll pay personal tax on your worldwide income. Now that's unavoidable. If you live there, you use their roads, their schools, their healthcare, that's just part of the deal. But what about your Dubai company? If you move to Spain and you keep managing that company day to day, running operations, hiring, making all the big decisions, then Spain will treat that company as a Spanish company for tax purposes. And you'll lose all the benefits of Dubai's low corporate tax rate. But if before you move, you appoint a local CEO or general manager in Dubai to run it, set up a small team or an office there, and create real substance, then you can remain a shareholder of the company, receive dividends, and your company will likely continue to be taxed in the UAE. In that scenario, you personally will just pay Spanish tax on the dividends you receive, not the entire company's profits. And interestingly, Spain actually has something called Beckham's Law, which can allow foreign workers to receive certain types of foreign income, including dividends, tax-free for a set number of years. So in the right situation, you could even structure things so that your dividends from Dubai are tax exempt. But what does this mean for you now? If you're still offshore or you've only recently set up your company offshore, it means you should start building the business you want to own in 5 years, not just the one that works today. If you're the only person making decisions, signing contracts, running everything remotely, that's fine while you're fully offshore, but it won't work when you move back to a high tax country. So start setting up proper systems and people. Hire a general manager who's based in your low tax country. Have them officially listed as a director or key decision maker. Hold occasional board meetings there, even if you fly in just for that. Keep proper records showing day-to-day management happens offshore. It's very common for online businesses to use freelancers or contractors, not just employees. That's great for flexibility and less admin for the business, but having a team of freelancers overseas doesn't help remove the decision making from you from a legal or tax perspective. If you want to have the flexibility to move back to a high tax country in future, you need to start building the future business you need now. And that's how you future-proof your structure so that when you're ready to settle down somewhere else, you don't have to suddenly dismantle your entire business or face massive taxes. Most entrepreneurs think short-term, how do I reduce my taxes this year? But the real question should be, how do I design my structure so it still works 5 or 10 years from now, even if my lifestyle changes? Because the truth is, most people who go offshore don't want to live there forever. They see it as a phase, a way to grow their business, build wealth, and set themselves up for the future. So while you're in that phase, use the time wisely. Build a structure that can survive a move back home. Hire the right people, create substance, and think of your company not just as a tax vehicle, but as an international business that stands on its own, separate from you. So to wrap up, the key thing you can do now to allow yourself to settle in a high tax country later on is create separation between you and the business. Build real operations in the low tax country. Make sure your company can function without you as the day-to-day CEO. If you found this helpful, please subscribe to the channel and drop a comment if there's a specific topic you want me to break down next. If you're looking to set up your business in Dubai, relocate elsewhere for tax purposes, or would like some accounting or tax support either in the UK or the UAE, you can find individual links to work with me in the description. Also, as a reminder, this video and channel breaks down tax topics to make them easier to understand, but it is not personal tax advice, and these videos are for educational purposes only. Everyone's situation is different, so please speak with a qualified professional specifically about your situation before making decisions about your taxes. Thanks for watching, and I'll see you in the next video where we'll be talking more about tax.